Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for watching my weekly stock market update for the week of July 15th to 19th. Before I jump into my charts and commentary, I would like to begin with my quote of the week, and this week's quote is from the Midrash, which is an exposition of the first 4 books of the Hebrew Bible. And in this quote, they say, "Many candles can be kindled from one candle without diminishing it." And those are some very wise words from the Midrash. And my elaboration on that is to please take your candle and light as many candles in your life as possible and share it with the world. Behind me, you'll see that my backdrop is a little sparse right now. That's because I'm opening a new office in Coeur d'Alene, Idaho in 2 weeks. So all of my books and decorations are being boxed up. So in a few weeks, you'll have a whole new backdrop for me to share with you. And we are very excited about that. We have loved the northern part of Idaho for most of our lives, and now we get to live there. So as far as the agenda for today, I'd like to begin with an update from John Hussman, one of the brightest minds in investments that I know. And I'm going to share with you his current update of the current valuation of the S&P 500 using 2 of his different metrics. And you will see that we are currently either the most overvalued stock market in recorded history, going back to 1928, or the second most overvalued stock market in history, going back to the 1940s, depending on which measurement you use. And then I'm going to show you a chart of the Dow Jones and S&P 500, which concern me greatly. I think there may be some serious trouble ahead for the Dow Jones Industrial Average and the S&P because we have hit overhead resistance, some of the strongest resistance we've had in 2 years or more. And I'm not sure that we're going to be able to get through it. So my words of caution are being said louder than normal when it comes to the stock market. Please use caution on your investments. And then I'm going to wrap it up with a chart from one of the other brightest minds in finance that I know of, and that is Sven Heinrich from Northman Trader. And I'll show you his words of caution due to the fact that we have, I think, 10 to 13 different gaps in the S&P 500 chart. And 93% of the time, gaps in charts get filled. And in order to fill the S&P 500's gaps, we would need to drop about 18% in the S&P 500 to do that. So, without getting too much into that ahead of time, I will stop there and let's jump into those charts. And before I do, please like or follow this video if you're watching it on Facebook, LinkedIn, or Twitter. And also, if you're watching it on YouTube, please subscribe to my channel, Christensen Wealth Management, and click the little bell next to it. All right, let's go ahead and jump into that chart, beginning with John Hussman. This is a chart of non-financial companies in the S&P 500 and their market capitalization, which means the total value of their stocks, all added up, divided by those same non-financial stocks and their corporate gross value added, including estimated foreign revenues. And what that second part means is how much are they contributing to the U.S. economy. So their total valuation as a stock divided by their contribution to the economy. And this is John Hussman's favorite valuation of the S&P 500 stock index. And you can see that going back to 1947, we are currently the second most overvalued stock market since then. And that is something that is giving John Hussman great concern. Let's take a look at his other chart, which happens to be my favorite, because it has more data going all the way back to at least 1928. In this chart of John Hussman's margin-adjusted price-to-earnings ratio, you can see that we are way up here on the top of Mount Everest. What this chart means is it's the price of the S&P 500 stocks, all added together, divided by the earnings per share of all those stocks added together. And you can see that going back to at least 1928, which is when this chart begins, investors have never paid a higher price for their stocks for the same amount of earnings in history, at least for 90 years of recorded history. So if you want to look at 2000, that is right here. That's 1999 and 2000, this peak there. 2007 was about right here. And you can see the best time to buy the stocks would have been down here in 2002, 2003, and also here in 2009 when those big dips came in just before we went from a level of about 14 all the way up to 45. Here is my favorite chart of the day. This is one that I created, and it's also the one I feel is most concerning because I believe it represents the Dow Jones slamming into a very strong ceiling that it may not be able to get through. This chart goes all the way back to July of 2017. And all I wanted to point out is if you connect a line from the highs of January 2018 to the high of October 2018, and you draw that line over, well, you can see that as of today, this is being recorded on after the close on Friday, July 12th. You can see that the Dow Jones Industrial Average not only gapped up between yesterday and today, but it ran up and hit that line perfectly and stopped. So next week is going to be a very important week because of the fact that we've hit that line. Now that line obviously goes back a year and a half. That is some very powerful resistance because of these were major highs on the Dow Jones Industrial Average, and we're coming into it with a pretty tired because we had to rally all the way up 7% and then a little extra 8 or 9% to get off those lows of May 31st or June 1st. So we're getting pretty tired in the Dow Jones, and to get up to these highs, I'm not sure it's got enough energy to get through them. But I will also point out that there's a gap here from last night right there, and we've got a gap at least right here from June, mid-June, and then looks like we've got a gap here from early June, and a gap down here from the first couple days of June. So lots of gaps in there, just like Sven Heinrich was saying on the S&P, except this is the Dow Jones Industrial Average. So we would have to drop about 7, 8, 9%, whatever, to get back down and fill all those gaps. So I would say that since we're up against this red line, that to me is the most cautionary warning sign of all. And just wait and see what happens the rest of July, and be careful with your money. Here's the chart of the S&P 500 stock index over the last 2 years, and similar to the Dow Jones Industrial Average, we have a situation where this index has also run into very powerful resistance. And if you draw a line from the peak of January 2018 to the peak here of September, October 2018 and extend it over, I'll show you what it looks like. As you can see, that as of Monday, July 15th, the S&P 500 has rallied up and touched that triple top or rising tops trend line. And in my opinion, that is some very troublesome resistance up there because it represents the prior highs that this stock market has been fighting to get above. And we have had a big rally since the end of May, and the stock market is tired. And now we're coming up to this very strong resistance with very little energy left in the gas tank. So be very careful with this S&P 500 because I would describe this red line right here as a concrete ceiling, and it's going to take a lot of firepower to get through it at this point. So we'll just have to wait and see what happens. Here is my favorite chart of the day from Sven Heinrich of Northman Trader, where he illustrated the S&P 500 and the many gaps that are in the chart of the S&P going all the way back to December. These yellow lines down here in the bottom represent gaps in the chart, and a gap means that between one day's close and the next day's stock market open, the price is set higher than the prior day's close, and it gaps up and leaves a void in the pricing structure of that particular stock index or particular investment. In this case, it's the S&P 500 stock index. So you can see that since Christmas, we have had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 gaps in the S&P 500 stock index. And statistically, gaps on charts are filled 93% of the time. And what does that mean? It means that the stock market or investment will decline, in this case, far enough to fill the void in the price that was skipped over. So what we would have to do in this particular instance is the S&P 500, if it does fit normal likely behavior, will decline to fill every single one of these gaps on this chart. And that would mean that we would go down over 20% all over again to fill this void down here from early January 2019. Let me calculate what that would be real quick. If we did that, it would be 3,006 is what the price of the S&P 500 is right now. And down here at Christmas time, we were at about 2,470 divided by 3,006. That would be, oh well, that's a 17.8% decline is what it would take for the S&P 500 to go all the way down and fill every single one of these gaps. Not saying that it will, but if historically speaking, gaps are filled 93% of the time, that means that means even the one down here has a high probability of getting filled. It's just a matter of when does it happen. And so we need to keep a close eye on that and the S&P 500 for a reversal in price and a decline all the way down to those Christmas lows. Thank you again for watching my video this week. If I can be of service to you, please let me know. Be happy to talk to you over the phone, through video conference, or a face-to-face, whatever works best for you. And I'd like to close today's video with my two favorite quotes. The first one is, "Getting back to even is not an investment strategy." And the other one is, "The best way to make money is to not lose it in the first place." And I'd like to elaborate on that and just say that if you do not have a risk management strategy in place for your investments, meaning some sort of a sell criteria or some signal that tells you when to put some cash on the sidelines or to protect the value of your account, if you are a buy and hold investor, please call me. I began my career in January of 2000, and I've been through 2 stock market crashes in almost 20 years. And I would tell you that buy and hold investing is not the best way to go when you are at some of the highest stock market valuations in history like we are right now, according to John Hussman. So give me a call. My information is at the end of this video or on my website or my social media pages. And I'll see you again in about another 7 days. Thanks again for watching. Bye-bye.